Hey everyone, welcome back to, another video from Meet Kevin. In this video, I want to break down a $600,000 investment that I made today in a stock that I think has been a little overly depressed, but also has potentially some very strong positive catalysts coming up, as well as potentially some negative catalysts coming up. And it's important to look at both of these time frames. So we're going to look at those, we'll talk about the company, look at the earnings, we'll look at the earnings call, we'll look at their S1 because, yep, they're a SPAC. And one of the things I want to start with before I start talking about the SPAC is SPACs are notorious, at least in 2021, for going up and then down and then up and then down. They have had an incredible roller coaster in 2021. In 2020, you could throw a dart, hit a SPAC, and win. It was easy. In 2021, you've basically got this minefield of SPACs out there. So you got to be careful. And in my opinion, look for companies that have passed certain catalyst dates, avoid other dates, and ones that are not down for really bad reasons. Like, for example, and I hate to say it, but Lordstown Motors is a SPAC that's down for not so good reasons. You've got executives fleeing and dumping shares, and you're the subject of potential fraud investigations. Not so good. So instead, I'm looking at a company that, in my opinion, has recently, just in the last 2-3 weeks, fallen substantially. And we'll talk a little bit about why they fell after their earnings and, of course, which company it is. So let's go ahead and start with which company it is. That particular company is Hippo. It is a home insurance company, which is very, very similar to Lemonade, but has some substantial differences. A lot of you know that I'm a big fan of lemonade.com. In fact, I even have an affiliate at lemonade.com, metkevin.com/lemonade. And they've got homeowners insurance, renters insurance, pet insurance, life insurance. Catalysts for Lemonade are great. You've got Google search trends, positive. You got website search trend data, very positive within actual website analytic platforms where we could see website data. Now, Hippo has less of that upward trajectory at the very moment. It's still a positive search trend, just a little less than Lemonade, so it's not as much of a growth. In fact, in a moment, we might even just compare. But Hippo does not have all of the products that Lemonade does either. Lemonade has homeowners insurance, renters insurance, pet insurance, life insurance. They're coming out with car insurance soon. So you've got a whole variety of insurances here, whereas with Hippo, you just have homeowners insurance. But in the homeowners insurance space, they seem to be relatively similar. Now, Hippo Insurance, what got me initially excited about them was realizing that they had a share lockup yesterday, and the thing plummeted on this share lockup. Let's take a peek here. Let's go out. Here we go. So plummeted on not only the lockup, but the lead up to this lockup. So we could see this was a SPAC. $10 SPAC price here. Before the merger, we saw it run up to about $15, and as momentum faded and SPACs became less popular around February, we kind of saw the thing bleed out to its pipe price of $10. This is pretty normal. It went public, or rather the merger occurred. This led to, well, as you see, a little bit here of a drop in the valuation of the company. Pretty substantial drop since the merger occurred on the 3rd of August. And recently, we had another lockup that expired yesterday. We saw another drop in the stock. So here's a stock that's been pretty dang battered. And I think I may have found one of the reasons and where it helps me understand the valuation for the company. And that's really where I want to start right after I show you a little bit more about what the company is. Well, then again, there's not too terribly much to tell you about the company. It's a home insurance company. So the argument is that you could get a quote within 60 seconds here. So you would just type in your address. And I think we know how to do this. So let's just type in an address here and ask you house, condo. One of the things that I noticed that I found just putting in different website addresses is they don't actually offer insurance everywhere. And in some markets, they've actually just totally stopped offering insurance at all. And the reason they're doing that is because they're really heavily concentrated in Southern California and in Texas. And one of the reasons they've gotten pummeled is because they have had some big losses that they reported because of the Uri storms. And then you got to put your information in. Anyway, you put your information and you get a quote. You get this idea. Because of the Uri storms in February in Texas and paying out claims related to those storms. Now, hopefully, that's just a one-time event. But Hippo has a ton of their contracts and insurance contracts in Texas. So this has really left them with a big fat bag of claims that they've been paying and paying and paying, which in my opinion, not super great, but potentially we're getting too much of that discounted into the value of the stock. And I'm going to show you the earnings in just a moment so you can see exactly where this comes from. But in my opinion, I think the stock market might potentially be overvaluing the losses from those Texas claims and undervaluing Hippo's efforts to diversify away from Texas, away from Southern California, and into other markets like NorCal or other states. Pretty important. So definitely risks related to continuing claims, especially out in Texas relating to the Uri storm that we had last February, which was really before we had the stock market really get a little bit more nervous because of inflation and valuations and those concerns. So home insurance company, one thing that makes this company, and then we'll look at valuation, one thing that does make this company different from Lemonade that I thought was interesting was right here. The company in their S1 talks about how not only do they offer direct-to-consumer sales, which is what we just saw, Hippo.com, but they also offer their insurance products through insurance partners like agents or producers and non-insurance partners. This was neat in my opinion. These are folks like home builders. So for example, if you go to buy a home from Lennar, they could probably, I imagine, set up some form of a affiliate relationship directly with the home builders to where when somebody creates or goes into a contract on a home, they could easily get the lender's preferred insurance company and the lender or the home builder's preferred insurance company, home builder preferred lender, home builder preferred escrow, right? They almost have something for everyone. This is pretty typical. Home builders already do this for lenders and escrow and title and all that. But insurance, not a bad idea to get into. Really, this is a company as well where their goal is to just attract as much attention as possible. Funnel in insurance, like advertising money, burn advertising money, and get as many customers as possible. And that's because with insurance, what you're trying to get is recurring revenue. You're trying to build a pipe of recurring revenue. They've got a retention rate of about 88% on the first year. Usually on home insurance, you do see that, and they didn't disclose this, but usually, at least with Lemonade, you see that go down to about 72% in year two. Year one with Lemonade's about 82% retention. So you have a slightly better year one retention. It's possible that they calculate their retention slightly differently, but Hippo's got a slightly better retention rate of about 6 percentage points over Lemonade for their home insurance. Or I should say all of their products, because Hippo just discloses their retention rate for home insurance. Lemonade discloses their retention rate for all of their insurances. And of course, they have many more. I mean, like pet insurance, life insurance, renter's insurance, right? Renter's insurance, pet insurance, life insurance. Well, with exceptional, I shouldn't say life. Renters and pet, those can be sometimes a little bit more transitory. Sometimes people are more likely to cancel their pet insurance because they feel like they don't need it, or that their pet is healthy, or they're likely to cancel their renter's insurance as they move, getting that sort of recurring contract. A little bit harder with renters versus homeowners. So, okay, this gives us a little bit of an idea about some of the differences between Lemonade and Hippo. But what I really want to do is look at some of the number differences. And what I did is I consolidated these onto a spreadsheet to make it a little bit easier just to look at some of the differences. So what we've got is we've got Lemonade here at about $77, and you've got Hippo at about $5 per share. Now, what I thought was neat was the market cap here is about $4.7 billion for Lemonade, about $2.7 billion for Hippo. And when I divide their top two sources of combined revenue, which would be the net earned premiums in the last 6 months and their commission income, I'll explain commission income in a second. When you combine these and divide them by their market cap, the valuation of the two companies is actually not too far apart. So on the left side, you're going to see here a market cap to sales figure of 47.3 for Lemonade, which, don't get me wrong, these numbers are huge, okay? These numbers are very, very, very big in insurance. This is not like food, where when you're selling food, you would expect to see like a 4 to 5 to 6 times ratio. The reason it's different is because you sell food, there's no recurring, right? With insurance, you're really making a bet that these customers are going to fall in love with the company, tell their friends, and they're the amount of products they use with that insurance company grow, or the amount of properties they get insured grow. That's what the bet that you're making with insurance. And this is why it's important to always compare to comps within the same industry. Something obviously we teach in the Stocks and Psychology of Money group, which I'm just going to be straight up here. We have not yet changed the discount code that's linked down below. And that is because it takes like 4 hours to do it. We've been buried with the campaign and other things. So if you wanted to check out that coupon code, you still could. But anyway, that price goes up over time. Every about 6 weeks, the price goes up. But anyway, this is important to know regarding the valuation of the two, that Hippo is actually slightly lower in valuation than Lemonade when you combine these two sources of revenue. Worth noting, that only does leave about 5% of room in Hippo in terms of catching up with Lemonade. But I personally believe that combined, Lemonade and Hippo are both a little bit on the low side. So what I mean by that is, let's take a look at the stocks, just go technical here, and then I'll come right back to the fundamentals. So let's just go here. Obviously, Hippo, in my opinion, $10 is too rich for the company. It's not a surprise, in my opinion, that this thing fell. Not a surprise at all. And so this, in my opinion, was justified. Like getting to $4 was justified. Now, being above $4, like $4 to $5, I think fair value probably somewhere $5.50. But I think it could run to about $7, and then it starts getting a little stretchy. So somewhere between 5 and 7, reasonable in my opinion. Start going above 7, too stretchy. I think you're held down here by this massive pipe sell-off that you had. I do think $4 is cheap for the company because it does discount it substantially under what Lemonade is. So sort of the cheap to stretchy valuation range. In terms of Lemonade, Lemonade has a little bit more of a history, and this is one of the reasons that I've been interested in Hippo and insurance particularly, is Lemonade has been following this particular support line here for a while. It dances above, comes back, bounce, 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 drops below, bounce, bounce, drops below, comes back. It always seems to come back to this level here. And I personally think that if we end up having low inflation readings come September 14th, which I kind of expect we're going to see an inflection point to the downside, I personally believe companies like Lemonade and even Hippo as a SPAC have the opportunity to run nicely in the short term. So for me, the position that I've established, which I'll tell you kind of exactly what I established soon, is not like a forever position. I'm not married to these stocks. To me, they're both good trade opportunities. I've got a lot of money in both of them. Lemonade is almost $1 million. Hippo is somewhere around, well, it's $600-ish thousand. Maybe because I do, and their valuations kind of marry together and will move together. Now, no guarantees, the market could fall apart in the next 2 months and we could have a big market crash and that these valuations go to crap. Who knows what's going to happen in the short term? If you lose money on it, it ain't my fault, it's your fault. I just want to make that clear. This is not financial advice. But personally, I'm expecting at least some form of a run on Lemonade. And at the same time as Lemonade runs, it's going to stretch that potential valuation for Hippo. So that's what I'm looking at technical-wise. Technical-wise, I think we've got room to go somewhere up to about this $7 level. And that to me is not offensive. Maybe around 125 Lemonade, $7 Hippo, 725 Hippo. Not offensive at all. And I would potentially just consider selling if we hit numbers like that. Which who knows? We'll see what happens over the next 2 months. I'm kind of prepping for that September, October kind of rally, but I'm looking for sort of discounted opportunities. And I personally believe this has the potential one, though you have to be careful because SPACs, they have this reputation where they go up, they go down, they go up, they go down, right? But anyway, take a look at this. So this is Hippo versus Lemonade. Worth noting that Hippo's ticker symbol is 1P versus 2Ts. But anyway, we talked here. Compare for a moment here. So you've got this valuation that's about a third less than Lemonade on Hippo, and you've also got net earned premium and commission income that's about a third less than Lemonade, which makes sense. The commission maybe a little bit more, and so to me, we've got a nice lineup in incomes. We've got a very nice lineup over here as well. Let's go ahead and draw right here. Look at this. Sales and marketing. You see right now, Lemonade. Look, these companies are spending money like crazy on marketing. Right now, it's all about how much money can you burn to get customers, because you're trying to get that long run growth, right? But anyway, right now they're spending 125% on sales and marketing at Lemonade. Hippo, 153%, so slightly more of those two top combined revenues. So they're spending more than they're making. They're burning cash. Now, Hippo, in their last earnings call, disclosed that they had, let's say it was 900. Let me find it here. I want to say they had $900 million as a cash balance. So I'm not expecting them to have to raise revenue anytime soon, which in my opinion is a catalyst that you want to look at. See here, including net proceeds from taking the company public, we had total cash equivalents, and investments at the end of Q2 of over 900 mil. Now they burned this, but they are also increasing their full year guidance from 544 million to 560 to 570 million. So a little bit, a little bit beating expectations or there in terms of forecast. We'll see if they actually end up beating. This here is the earnings call. It's worth noting the date here. This just took place too on 8/16. And I personally like having catalysts like that out of the way because in my opinion, the volatility drops and then it's a little cheaper to look at like options and things like that. But the 16th, worth noting, was right here on the chart. Let me go to the non-average just so we could see this a little bit. So leading into earnings, this was the day after earnings. You had like a 15% drop after earnings. So I'm looking at this like 15% drop after earnings and a drop after the PIPE shareholders get out. And one of the big reasons we had, in my opinion, this drop during earnings was because of Texas. Take a look at this. If we jump on over to this here, I put it, kind of wrote it out here. Let's just go ahead and use orange here. All right, where is, right here, losses. Okay, look at this. Lemonade had losses of 29% in the quarter, which would be April, May, June. That's Q2, April, May, June, which is literally when you would expect payouts about 4 to 8 weeks after the Uri storm, maybe even 8 to 12 weeks after, right? You expect big payouts in literally April, May, June. Look at these losses, 38.7 million losses, huge losses, huge losses. But in my opinion, that was a once a decade type of storm in Texas. I could be wrong. Climate change folks might want to argue that happens all the time, right? But it's worth, in my opinion, noting that at least I think one of the reasons we had such an epic fall over the last 2 weeks and this sort of acceleration of a fall in the stock is right here because of these 38.7% or 38.7 million in losses, which, look, Lemonade obviously has more net earned premium than them, has more commission income than them, doesn't spend as much on advertising. Their G&A is relatively similar in scale, so is their tech and development. Relatively similar companies. This is why it's so important to look at companies that are similar. They don't have to be exactly the same, like real estate, you don't get that privilege, but look at similar companies. But anyway, yeah, that loss, 38.7, I think was a big slap in the face to this stock and really helped depress this stock and also gave PIPE investors the anxiety they needed to just dump out. And that's one of the reasons I've been looking at this as a potential buy the dip opportunity. Who knows? Like, full disclaimer, the darn thing could literally just go down to $2 or something. I don't think so. And the reason I don't think so is because I think there's a rubber band between Lemonade's valuation and Hippo's valuation. And I think that rubber band sits at about $5.25. $5.25 on Hippo for every $77 that Lemonade is. So that's about that rubber band that you have. And then, of course, you could have fluctuations between the two. Like, personally, I think, this starts getting stretchy around 7. I think this over here gets stretchy around like 125 or something like that. Things like that to consider. Okay, so yeah, let's see what else we have here in the earnings, and we can do some Q&A as well. Worth mentioning that you do have, even though you had a PIPE lockup, you have other lockups coming. You've got following the August 3rd closure here. Yeah, let me make sure of this really quick. Pursuant to sponsors based on a 10-year following following the closing. So business combination lockups, you have 6 months after August 3rd, 12 months, 18 months, and 24 months for lockups. So if you go long on a stock like this, it's worth noting those dates. Like I would just put them on a calendar right now if you plan to hold this thing for more than 6 months. So that way you're not like shocked when the price falls on those days. And if anything, it just encourages you to potentially buy the dip. SPACs, you got to be careful. I always recommend being very careful with SPACs. You do have warrant liabilities, very important to keep in mind. It's kind of like with SoFi. You have warrant liabilities, about 137 million right here. And these will create dilution when they come up. I want to say the warrants come up in November. Let me see. I saved that. Here we go. Look at that. Outstanding warrants to purchase 9 million shares of Hippo common stock are exercisable 12 months from the initial IPO closing of the blank check company, which is November 23rd, 2021. So this is the next short-term catalyst you really want to pay attention to, in my opinion, right here, is November 23rd in terms of a downside risk, okay? November 23rd, downside risk. Now, if you are a trader, in fact, I'm kind of sometimes a trader. I'm going to write this down. So what I'm going to do is I'm going to go into my calendar right now. And I don't know that I'm going to hold the thing for 6 months. I think it's going to be more of a shorter term. Let's see here. I always like to be transparent. Okay, here we go. So I'm going to put in, oh, that's 2 days before Thanksgiving. I'm going to put in November 23rd, Hippo warrant exercise. Now, it's possible that they could be redeemed earlier. So it does not have to be on that date. If the company decides to redeem earlier, then you know, that's something that could happen. But it's worth noting, actually, and I kind of forgot to mention this because usually this is the issue. These actually might end up expiring worthless. So hold on a second. I'm going to save this date. Hippo warrant exercise at 11:50. Nobody's going to exercise this stuff. This could actually be a more positive catalyst than negative. That's actually really interesting. I don't think I've personally encountered that before. Okay, let me set a little reminder. Okay, yeah, there we go. Okay, so this is interesting. See, warrants are kind of like call options. Warrants give somebody the right to buy this stock for $11.50. But wait a minute, it's like a $5 stock. So why would somebody exercise the warrant at $11.50? So if all of these, so in that case, I don't think the company's going to redeem these warrants. They'll just let these things expire worthless. Imagine you sold a call option on Hippo for $11.50. If it's trading under, you collect the premium, which is $1.50 for Hippo, and that liability could literally vanish off their balance sheet on November 23rd. That's actually, instead of being a negative catalyst, that's a potential positive catalyst, in my opinion, as long as the stock's trading under 11.50. Under 11.50, I'm going to write that down too. So that's interesting because if these expire worthless on November 23rd, take a look at this. You go over here to their balance sheet, and that basically means that their warrant liabilities will expire entirely. Like this will disappear. They won't have warrant liabilities anymore because their warrants will be worthless. Now, these are the preferred stock warrant liabilities. So I'm going to have to double check to make sure I'm looking at the correct line here for warrant liabilities. But that's the only reference I see here, with the exception of subject to possible. No, those are shares. Yeah, I'm going to watch that date. I think that date is really interesting. And total kind of a little twist on what you usually expect to see with warrant redemptions. Usually they're dilutive, and you end up having the stock price fall when the company redeems. All right, so what else do we have here? We talked about August 3rd. What do I got over here? Oh, this was interesting. This is just sort of their mentality here. Oh, and I also have to talk about reinsurance. So let me put that down really quick. Reinsurance. Okay, here. With $110 billion in annual premiums, the U.S. home insurance industry is deeply fragmented, with only one carrier accounting for more than 10% of total market share. Fragmentation in the market sets the stage for positive traction for new entrants. This is not a winner-take-all industry. I really liked that they threw this phrase out here because it just shows that there's so much opportunity for getting premiums out there, right? They're right. I mean, there is no winner-take-all. It's not like if Tesla comes out with full self-driving, that's it. They're winner-take-all, right? And we know that, excuse me, with Lemonade as well. This here is a Lemonade, which Lemonade, it's worth noting, does a reinsurance. So let's talk about reinsurance. Lemonade does 25% reinsurance. So the way that works is if Lemonade collects $1,000 of premium. So they collect $1,000 of premium. And then all of a sudden, Lemonade says, hey, we don't want to keep all of this risk. We're going to sell 75% of the risk to someone else, or rather let someone else take on that risk, right? So 75% reinsurance means they're going to actually give away $750 of that premium, but they're going to take a 25% commission for giving that business to another insurance company. So they're actually going to get 25% commission. And that works out, I believe it was $196. It was something right under $200, $196. So all of a sudden, this means Lemonade is actually profiting 200, let's see, 196. What is that? I can't do the math in my head today. 196, it's 200, 444. That means Lemonade's profiting about 404. Did I do that right? Let me just do it. 196 plus $250. Yeah, 446. I knew it was close. There we go. That means Lemonade's profiting about $446, but only actually taking 25% of the risk. So that's how Lemonade does their business. Hippo, they take reinsurance for substantially more. They take reinsurance up to, I believe, 90%. So they're trying to take less risk, and I think that might be possibly because of Texas. It's just worth noting they're going to have to get a whole lot more clients because of that. But so far, they've been doing pretty well. Let me see if I could find that in here. And then I'm going to go to their earnings call. Reinsurance. I'm just going to, they mention reinsurance so many times. Here, I don't want to make this spastic. So let me just hide this for a second while I just quickly search through for their reinsurance terms. Reinsurance is a stock risk, by the way, because it does mean that at least some of their revenue and their commission revenue is subject to the going market rates for reinsurance at other companies. Though generally, you do not have issues getting reinsurance. Like there are plenty of reinsurance providers. All right. We've always pursued an asset-light capital strategy to support the growth of our business. Here we go. Even though we acquired Spinnaker, a licensed carrier, we generally only retain as much risk on our balance sheet as is necessary to obtain attractive terms from reinsurers who bear the risk of the policies we sell. Those reinsurers usually require companies like Hippo to retain some interest. So that way, it's not like Hippo's just underwriting like horrible policies, right? For policies written in 2021, we expect to retain approximately 10% of the risk associated with these policies. I personally think that's pretty low, especially compared to Lemonade, which Lemonade, is keeping 25% of the risk. So I did think that was a little bit low, which in some sense could be a little bit of a benefit since they obviously just got smacked in the face with their Texas policies, which it's worth noting on their earnings call here. They spent a lot of time talking about Texas. I think actually that's how they opened. Let's see here, direct to consumer. Let's go to the big items here. Oh yeah, here. Texas storm. In Q2, we had a small amount. They say small amount of net negative deployments, but they had big losses because of your, there's an earnings call here. This contributed to an approximately incremental 14 percentage point loss on our gross loss ratio. Blah 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 blah. Okay, so they regularly talked about the importance of diversifying away from Texas because of the impact that they had. Now, obviously, not all of their loss was because of Uri, but they had a big loss because of Uri. And this was talked a lot about in their discussions and their Q&A here. So I mostly just want to look at some of the things that I highlighted here in red. And this was Hippo's argument that rather than doing the Lemonade approach of only doing direct to a consumer, they're also working with brokers allowing brokers to sell Hippo insurance, and also getting referral commissions from referring business to other folks. And then, of course, also getting, hold on a second, let me make sure I'm good. Time for, okay, there we go. And then also working with builders like Lennar. Okay, so that was interesting. Let's see here. Oh, another thing that was sort of an interesting argument. I'm not sure I'm like 110% sold on the argument, but I thought it was interesting. As they talked about how their product kind of leads people to unbundle. That is, with Geico, you might have home and auto, but Hippo doesn't do auto. And they actually think society is going to go towards a little bit more of an unbundling, to where people are like, well, I get my home insurance here, I get my life insurance over here, or whatever, which makes sense when you look at a company like, if you go to metkevin.com/life, that is Ladder Life Insurance. That's what they do. They do term life insurance. That's it. That makes sense when you look at a company like Hippo. They do home insurance. But you look at a company like Lemonade, they're trying to go bundle, and get that lifetime client value. Now, again, I think for the time being, Hippo and Lemonade are kind of going to chase each other on that ratio, 48 times their total revenues to market cap. But that could change if Lemonade's bundling model ends up working out better than Hippo's bundling model. But Hippo has those multiple sale directions. So, all right, let's see. They talked about their retention. We talked about that. Talked about the consumers. They partnered with Ally and Incline to do a little bit more underwriting. One of the issues they did complain about was having trouble getting labor, actually, because of labor shortages, COVID, having that sort of struggle and making sure they get that underwriting, and so on and so forth. So, yeah, these are, let's see, and then, of course, geographic diversification, getting away from the pain of Texas and SoCal. So, for example, I went in and tried to get insurance for properties that I have in SoCal, especially I have to get a new insurance policy. And they said, hey, right now we're actually closed to new policies in SoCal because we're basically have so many people already in SoCal and Texas that we're trying to diversify out of those markets, so that way if there's a flood or an earthquake or whatever, not that they necessarily do earthquake insurance, but then they can provide adequate coverages and not have too much risk. And I think that's really because they got spanked in the Texas storm. So yeah, in my opinion, some things to keep in mind here. It's a SPAC. It's something that actually I think has some positive catalysts coming up. Not only do I think September, October or potential rally months, I think that we've got a positive catalyst on November 23rd with those Hippo warrant expirations, especially if it trades under $11.50. That'll remove liabilities from their balance sheet. Ironically, it would actually be good if they traded under $11.50. You've got Lemonade, in my opinion, is poised for a movement. This is something that, in terms of investment, I sent out an alert to the folks in the Stocks and Psychology Money Group, because obviously anytime I trade, I send an alert there. You can still use that coupon code tentatively down there. We're having a little issue changing pricing. And but yeah, I put most of my money in as shares. I get a little nervous if I just do all options, especially call options. You have to be so careful because theta decay is really bad. I did about, what did I do? About 10%, no, like 18%-ish. Is that right? Let me see. I'll tell you really quick. 21% in a call option and 79% in shares. So the vast majority of my investment was in shares today. Although I do have a call option. I think I did the in the money $4. I did purposely pay a little extra to go in the money, so I did pay some more premium for that. Out of money tend to have, the theta decay is just like way worse, and I don't love out of the money call options. I also generally, if this thing runs, say like, I don't know, Wednesday, it's like $7 or $8. I would probably get rid of my call option and then sell calls on the stock. And it depends what the implied volatility is. If it trades sideways, whatever, we'll be patient for this potential rally in September, October. Who knows? Maybe that doesn't come. But that's called investing. I do think that like 550 and below, 450 to 550. I think that's a fair price for the stock. And I do think when the market gets a little excited looking for opportunities again, I think Lemonade and Hippo are potentially on that radar, next week. We can only have a 4-day week next week. So next week, the week after, and really going through October. Some people are saying that they think there'll be a September rally and then an October dip. I don't know. Who knows? So I'm seeing some of your comments here that I can't specifically help you with the homeless people in front of your house. So sorry about that. Hodl Lemonade, awesome. I love Lemonade too. I think they're both great. So let's see here. What else we got? Time for Topo Chico. Exactly. So the options are always a YOLO, right? Options are a shorter term options are a YOLO. Absolutely. Petrodollar, not something we're going to talk about now. Minor stocks. Yep. Okay. So not too many questions here about this particular stock. This looks like some other fun comments. All right, cool. Hey, folks. Well, thanks so much for being here. I don't have an affiliate link for Hippo, but I do have one for Lemonade. So for what it's worth, go to metkevin.com/lemonade. But look, I like both of them. Kathy Wood is not a big fan of insurance companies. Her problem, not mine. So worth mentioning that as well as a disclosure. Okay, folks. Thank you so much. We'll see you in the next one. Goodbye.